Welcome students to the next lecture in the series. Let's begin. In this video lecture we will continue with the uh, various functional budgets that we started. We have studied few of them, and in this lecture we are about to study an important form of budget, cash budget. Let us start. You know that cash is an important element of your financial statement. Cash budget is one of the most important and the one which is prepared at last because it shows all the detailed estimates of cash receipts from all the sources and cash payments for all the purposes and the resultant cash balances during the budget period. Budget period can be depends on the situation. We can have annual budgets or for 6 months or for a quarter or for a month or even for a week, depends. It makes certain that the business has sufficient cash available to meet its need as and when these arise. It is a device for coordinating and controlling the financial side of the business to ensure solvency and provide a basis for planning and financing required to cover up deficiency in cash. Cash budget also plays an important role in financial management of a business undertaking. So we are able to see that how important is it. Let us see and understand its purpose, the basic objective behind preparing um, cash budget. It ensures that sufficient cash is available because you know that cash in excess or in shortage, uh, both the situations are not useful. Next that we have that it indicates the cash excesses and shortages if there are any, because both the situations I was telling you is like not good, so that we can take an action in time to invest any excess cash for the further profits, and in case we are having shortages we can borrow the funds in time. It establishes a sound basis for credit. It shows whether capital expenditure may be financed internally or not, or we may have to uh, like procure any loans from any outside sources. Then it establishes a sound basis for the control of cash position, because cash position is an important part. Then preparation of cash budget. We do have three methods of preparing cash budget. We have receipts and payments method, adjusted profit and loss method, balance sheet method. Let us begin with the methods one by one. First, we have receipts and payments method. In this method, we usually use short-term cash forecasts and is much more detailed other than the other two methods. Cash budget begins with the opening balance of cash in hand and at bank. To this, we add all the cash receipts from various sources, and from this we subtract, or you can say deduct, all the payments of cash, whether on capital and revenue account. The resultant figure is the closing cash balance. Cash receipts here can refer to anything that is through which we are able to receive cash, like cash sales or collections from debtors, interest on investments and loans, sale of capital assets, miscellaneous sources can be there. So in the case of credit sales, adjustments are needed to be made for the time lag between the point of sale and the realization of cash. If I talk about cash payments, they are made for raw material purchases, direct labor, out of pocket expenses, capital expenditure, projects, dividends, etc. The period of credit appropriate to the payment concerned should be taken into account. Now let us have a look to a numerical on the space. Here, company is expecting to have 25,000 in cash in hand as on 1st of April 2010, and it requires you to prepare a cash budget for 3 months from April to June. We are given with information from February, March, April, May and June, because we may be using certain information from the prior month and the upcoming months. Let us see the other information given to us to understand the question. Period of credit allowed by suppliers is 2 months, 25% of sale is for cash, and the period for credit allowed to customers for sale is 1 month for the credit sale. Delay in payment of wages and expenses can be of 1 month, and income tax of 25,000 is to be paid in the month of June 2010. Let us see how to draw. This is the way, we will draw cash budget for 3 months ending June 2010. We will start with opening balances and then receipts, cash sales and debtors. Cash sales we can pick out from the 3 years. 25% is cash sales, we know. Then we have debtors. We will be totaling horizontally as well as vertically. Both ways we need to total. Okay. Then further we have payments. We need to subtract them. Creditors, wages, expenses, and income tax. Finally, we need to pick it from the requisite month that we are supposed to, and we can have the closing balances finally, and we can have the total at the end. So this was an example for your cash budget. Now let us see the second method, now adjusted P&L account method. This method is suitable for your long-term cash forecast. It is basically based on the view that it is the profit that is the source of cash in the business. The profit as per profit and loss account is converted into cash figure by preparing an adjusted P&L account, and all those items of income and expenditure like depreciation, provisions, etc., which do not involve any inflow or outflow of cash, is adjusted in the forecasted profit figure so that we can arrive at a cash figure made available by profit. Okay. We'll see a cash budget performer under this method showing the various items that require adjustments in the profit figure for finding out the cash position at the end of the particular period. The adjusted P&L account. The adjusted P&L account is often termed as cash flow statement even because it converts the P&L account into cash forecast. The main difference between this method and the receipts and payment method that we have just studied is that whereas the former considers the non-cash items for adjustment in the profit figure and the latter takes into account only the cash transactions. So it is appreciated if we under this adjusted P&L method, if we do have the equation that profit equals to cash, which actually holds good if there were no credit transactions, accruals, capital transactions, depreciation, stock fluctuations, or appropriation of profit. But such a situation cannot exist in practice actually. Then we have balance sheet method. This method is also used for forecasting cash requirements for long periods and is rather similar to adjusted profit and loss account method that we have just discussed. Under this method, a budgeted balance sheet is prepared with all items of assets and liabilities, excepting cash and bank balance, because the two sides of balance sheet are then totaled and the balancing figure is taken as cash. If the liabilities are more than assets, this reveals a balance of cash or bank. If assets exceeds liabilities, this reveals a bank overdraft. This is the pro forma. You can see we begin with the opening cash balance and we add all the sources that we have. We begin with budgeted net profit, depreciation, provisions, basically non-cash items, sale of plant, issue of capital and debentures, reduction in debtors, reduction in stocks, accrued expenses, increase in liabilities, and we can have the total additions and total cash available using this. Then we subtract the payments like dividends, prepayments if there are any, capital profit, increase in stocks, increase in debtors, liabilities, and finally we have the total deductions and obtain the closing balance of cash. So under the adjusted P&L method, cash figure is computed by preparing a cash flow statement, and the same figure is computed as a balancing figure under the balance sheet method. Then finally, last category is master budget. When all the functional budgets have been prepared, these are summarized into what is known as a master budget. Thus, a master budget is a consolidated summary of all the functional budgets. If I define it as per CIMA London, master budget is the whole summary budget, which incorporates its component functional budgets and is finally approved, adopted, and employed by the top management. Here we have the two parts: operating budget, basically the budgeted P&L account, and financial budget, that is the budgeted balance sheet. So thus a projected P&L account and a balance sheet together constitute a master budget. It is prepared by the budget director or the officer and is presented to the budget committee for approval. If approved, it is submitted to the board of directors for final approval. The board may take certain amendments and alterations before it is finally approved, and it actually acts as the backbone of the whole organization. So hereby we complete all the types of your functional budgets. If you have any queries regarding this, you may write to me, you may contact me. Till then, take care.